Jeremy Finger here, Riverbend Wealth Management, here to share with you Student of the Market Update 2024 March. So first slide is, this is the agenda. We're going to go over a little bit how stocks have fared so far this year and what does that mean for the rest of the year, potentially, historically speaking. A little bit about cash, when bond yields rise and fall, and how cash performs against a 60-40 portfolio. So let's get started. All right. So we have had a positive January and a positive February. Historically speaking, what does that mean for the rest of the year? Only 2 times out of 34 years have we had a positive January and February, and we've had a ended negative for the rest of the year. The average annual return when we have a positive January and February is 11%. If we have a positive January and a negative February, the remaining 10 months is average annual return of 13.9%. And if we've had a negative January and a positive February, the average annual return for the remaining 10 months has been 5.9%. Volatility has been relatively low. So in other words, you really haven't seen a lot of up and down movements of the stock and bond market as of the past year or two. And that's been pretty positive for stocks. Now, I'll say that it's kind of unusual that we've had this low volatility. But when we have a low volatility or low volatile environment, that's typically been very positive for stocks, as you've probably seen in your statements. Well, what if the Fed cuts rates? Typically, that is a positive for stocks if we avoid recession. Now, many different economists out there do not predict a recession this year. Okay, and historically speaking, people are pretty bad about their accuracy on predicting recession as well. But if we avoid recession, typically stocks have done well after a rate cut. And as you can see here, after the first rate cut, stocks and we avoid recession, stocks have gone up on average since 1984, 21%. That said, if we have a rate cut and a recession, stocks have dropped by 5.6% on average. And you can see the returns from bonds there. A lot of times, at least recently, because stocks have done so well, people have kind of shied away from bonds, which typically a bond, and that's kind of how I like to frame it, is a bond is like shocks on a car. Usually not a lot of up and down movement, but it's much more consistent. It gives you a smoother ride. And stocks are more like a sports car. Probably not as many shocks, but you go a lot faster. A little bit more bumpy. So, strong performance. Okay, so a lot of times people say, hey, Jeremy, we're at markets at all-time highs. You know, should we invest? Typically, well, historically speaking, you can't get to 10,000 without going through 5,000. You can't get to 20,000 without going through 10. You can't get to 30,000 without going through 20. So stocks are going to, if they go up, they're going to pass through certain milestones. So if you look at this chart here, when stocks pass this is S&P 500, by the way. When stocks pass the 2,000 mark, it fell below the 2,000 mark 11 times and then went to proceed to make 168 new all-time highs before it reached 3,000. And when it hit 3,000, it dropped below 3,000 7 times, and it went on forward and made 142 highs. So in other words, think of it like a tree. A 10-foot tree had to be a 9-foot tree at some point. And that 9-foot tree had to be an 8-foot tree at some point. So we don't really know exactly when the growth is going to happen. But, if we invest early, invest often, and live within our means, and have good quality investments, over time it should work out. And we're over 5,000 now, and we don't know what the next 12 months may hold. But again, invest early and often. Make sure you live within your means, and buy quality investments. All right, mutual. Okay, so a lot of times what people want to do is buy individual stocks. Okay, and over the past 5 years, only 64% of individual stocks have made money. 36% have lost money. And I know a lot of times people say, well, I bought this ABC stock or this DEF stock and made this or made that. But you really are betting on one horse versus a group of stocks that probably are going to put odds in your favor a lot better. Of those 36% that lost money, 884% lost anywhere between 0 and 24%, and 33% of the stocks that lost money lost more than 25% over the last 5 years. The last 5 years have been pretty good for the stock market, and could you imagine losing 25% over that period of time? So, statistically speaking, it'd be better off buying a mutual fund or ETF where you get a broad range diversification. So a lot of times it's the best way to get mega rich, but it may be the best way to keep you rich, so to speak. All right. A lot of people have money in money market accounts right now, and currently they're paying historically a decent interest rate. However, they underperform bonds most of the time. And even last year in 2023, bond funds, and if you remember, a bond is an investment that basically is debt that's paying you interest, and then you get principal back later. But that has outperformed outperform money markets for 84% of the time. All right, and so bonds have historically seen a positive price return when cash yields fall. So if we go into a interest rate cutting environment, which we may experience, bond total returns have done quite well. And as you can see here, from 1976 to 2023, when core cash yields went down by 1%, the total return of bonds has been over 12%. 8.2% has been the yield on the bonds, and a 4.1% has been price appreciation on the bonds. Okay, so the income yield is kind of the interest you're getting paid, and when the bond when the yields go down, prices go up on bonds. Okay. And you can see that conversely, if cash yields went up, you still get the interest, or you could get the interest on those bonds, but you may have some negative effects on the prices of those bonds, which if you've held bonds in 2022, that's what you experienced. Interest rates going up, and it had a negative effect on your bond returns. Okay? All right, so what do? Well, this is a 60-40 portfolio, 60% stocks, 40% bonds. And how is that compared against cash? Well, cash is outperformed 28% of the time, as you can see in this 1-year return. But over a 2-year period, it's only outperformed 23% of the time. And the longer and longer you have the money invested in a 60-40 portfolio, the odds are that is going to outperform cash. Does that make sense? Okay. And what another key to that is the how much it underperforms. So cash may underperform by 6.1% on average the first year, But the longer and longer that money's invested in 60-40 portfolio versus cash, the distance between the two becomes greater and greater. Okay? So, I mean, think about it like two horses. You got a cash horse and you got a 60-40 horse. Maybe that cash horse might outrun you for a short distance. But over time, that 60-40 horse makes tremendous gains over time, historically speaking. And you can see that over a 20-year period, that's 384% difference in return. Quite substantial. And disclosures for all the attorneys out there. If you get any questions about anything, certainly feel free to give us a call at 843-970-1049. And or send me an email at jeremy@riverbendwm.com. Hope all's well with you and your family, and you have a great week. And let us know if you have any questions. Bye-bye.